Can you minimize taxes in 2023? Absolutely. In this educational episode, I'm going to disclose if you don't, you're going to be left in the dust. Stay with me. You'll understand how to perform a strategic rollout sooner than later. I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now and a tax minimization specialist for nearly 5 decades. And I help people prepare for a comfortable retirement so that they will not outlive their money. Now, why do most Americans outlive their money? It's due to 3 big dangers, 1, 2, or all 3. The first danger is taxes, okay? And if you can't see the writing on the wall because of irresponsible government spending and the printing of money, taxes are going up. We're talking about income taxes, estate taxes, capital gain taxes, corporate taxes, and also the hidden tax, inflation. Inflation is the second big danger that causes most retirees to outlive their money, because at the current real rate of inflation, which is over 15%, the cost of living will double in less than 5 years. So if you're going to need, in less than 5 years, $200,000 to buy the same gallons of gas and loaves of bread that 100,000 buys today, you better have a strategy that will help you outpace inflation or keep up with it, okay? The third big danger is market volatility. Market volatility usually happens because of the government causing these recessions and volatility in the market because they are spending money like crazy. So if you're not aware of what's been happening, maybe your head's been in the sand, but generally, you know, the government through the IRS brings in revenue, Internal Revenue Service. And in 2019, 2020, the IRS would collect in revenue usually about $3.8 trillion. They would refund about $800 billion in tax refunds, and they were netting $3 trillion. Well, because of COVID-19, they basically spent in the unemployment benefits and what have you, double what they brought in. They spent more than $6 trillion. Now, come on. If you made $100,000 and you spent $200,000, you got to do something to pay off that extra $100,000 you borrowed. No, they didn't do that. Instead, they said, oh, this is a good excuse to pass a whole bunch of other spending measures. And so they passed all kinds of spending where basically they're spending about 3.5 times what they bring in. It would be like if you were making $100,000, now they're spending $350,000. Well, for us, you'd have to file bankruptcy or something, see? Well, the government, they simply print money and they raise taxes. And so this is what's going to happen, and I want you to be immune from those as much as possible. Now, if you're already retired, I can help you really, really well. If you're approaching retirement, I would strongly recommend that you begin to convert as much of your money that's accumulating and that you're going to be accessing to tax-free, not tax-deferred accounts like IRAs or 401ks. And so when I go out and I teach the general public how to maximize rates of return and minimize taxes, one of the strategies that most people want to embrace is what I call a strategic rollout. Now, this is not a rollover, okay? A rollover is like going from the frying pan to the fire, so to speak. This is where you might have money in 401ks, and then as you approach retirement, you roll them over to IRAs. Why? Because your advisor said, oh, if you don't need the money, keep deferring, thinking you're saving tax. That's very myopic, short-sighted. You're not really saving tax in the long run. You're continuing to defer, procrastinate, put off, and compound the problem. So, if you say, well, how much can I save in tax this year? Well, then don't take anything out. And then when you're 72, just take out RMDs, required minimums. Well, in the long run, that doesn't save you tax. If you actually added up the taxes you'll pay by taking that advice of RMDs, postponing, deferring until you're 72 and taking RMDs, most people are flabbergasted with the amount of tax they'll pay out to their life expectancy and their spouse's life expectancy. And then as it transfers down to their heirs, they have to now get it out and the tax is over and done with within 10 years. They can't wait until they retire necessarily, okay? People are shocked how much tax they'll pay by doing that. But that's what most people are duped into doing. Well, I say, no, don't do that. Do a strategic rollout. Get the money out sooner than later in today's lower tax brackets and get the taxes over and done with and reposition the net after-tax money into something that's going to be tax-free from now on. And at the end of the day, when you die, you'll be reimbursed, or your spouse and your kids will be reimbursed any of the taxes you did pay, so you're not going to be out anything. You're going to come out ahead. And people say, that sounds too good to be true. What are you talking about? You're doing a strategic rollout to max-funded indexed universal life insurance contracts because they accumulate your money tax-free. You can access your money tax-free, but at the end of the day, when you die, anything left in there blossoms and transfers income tax-free, which reimburses you many-fold for the taxes you pay in most circumstances. And so that's called a strategic rollout. So in a lot of these educational episodes on this channel, I give actual stories and examples. I'll give you highlights of about 5 right now, okay? Years ago, I met with 2 school teachers, both a husband and wife. When they came to me, they had $250,000 accumulated in their 401ks and their 403bs and tax sheltered annuities. And their advisor, because they were 59 and a half and they didn't have to pay a 10% penalty if they started accessing money, but their advisor says, well, if you don't need the money, keep deferring. And so I said, okay, let's look at doing that. If you deferred until age 70 and a half, which is when they had to start taking RMDs back then, that $250,000 at a 7.2% rate of return would have likely doubled to $500,000. And then we took RMDs and they were shocked. Out to the husband and the wife's life expectancies, they were going to pay at least $250,000 in taxes, and that's assuming tax rates never went up. I said, do you want to pay $250,000 of taxes? They go, wow. Well, yeah. I said, so do a strategic rollout. What? We have to pay tax now? Well, in a nutshell, we did a strategic rollout of $60,000 a year. Now, they had to report that on their 1040 tax return. They didn't use the money, but we only paid $12,500 a year in tax for 5 years. 5 times $12,500. They paid $60,000 in tax, but that's better than $250,000. But then I was able to resurrect deductions on 2 of their rental properties, and that created or resurrected deductions that offset the tax on that $60,000 a year of withdrawals. And so we were able to get out $250,000 out of those 403bs and 401ks with no tax consequence. Well, we were able to double that to over $500,000, but that $500,000 was able to generate $50,000 a year of tax-free income. We way more than doubled their retirement income, and they were far better off. They were so glad that they came in and performed a strategic rollout. Now, we have done this many, many times. The second example is a real estate landlord that came to me with $600,000. His advisor said, just take out the 4% rule at age 70 and a half, which would have been a measly $24,000 a year. In a 33% tax bracket, he paid $8,000 in tax. He was only netting $16,000 a year to buy gas and groceries. That's pathetic. In fact, it was unacceptable to me. Long story short, we did a strategic rollout. We took out $150,000 a year over 5 years because we grew his $600,000 to $750,000. So we pulled out $750,000, paid tax of a third, $250,000. We netted $500,000, but that $500,000 began to generate $50,000 a year of tax-free income. How much better is $50,000 than the net of $16,000? It was more than triple. The real truth is We resurrected deductions for him on his rental properties, and we actually got out $750,000 totally tax-free. He actually was earning $75,000 a year of tax-free income at the end of 5 years, and he was thrilled to do a strategic rollout. We had, in our third story, a couple, husband and wife were both physicians. They came to us and had saved $4.6 million in IRAs and 401ks. Their advisor said, oh, just take out RMDs. Well, I calculated, and they would have paid $2.6 million of unnecessary tax throughout their life expectancies. And their advisor said, well, they can afford it. I said, well, let's ask them. I said, I can't save you $2.6 million. You've really painted yourself into a corner here, a tax trap. But I could free up $1.2 million. I could save you $1.2 million. Would you like to do that? They said, absolutely. We did that. That extra $1.2 million that it would have gone down the drain in an unnecessary tax in an IUL contract has been generating $100,000 a year of tax-free cash flow for them, their kids, their grandkids. They are thrilled that we saved them $1.2 million of unnecessary tax. We did that in the fourth story with a couple in California that came to us with $2.6 million. And that $2.6 million they thought would generate, $160,000 a year at a 6% payout of taxable income out of IRAs and 401ks. They had another $40,000 coming from a school teacher pension. So they thought they were in pretty good shape with $200,000 of income. And I said, well, yeah, but it's all showing up on the front page of your 1040 tax return. They said, there's another way. And I said, absolutely. We performed a strategic rollout over 5 years. We got 60%, $120,000 of that $200,000 off of their 1040 tax return. We saved them $40,000 a year in tax the rest of their lives. We saved them over $1 million in taxes the rest of their life. But we basically took their $200,000 of income. We actually increased it. But now only $80,000 of it shows up on their 1040 tax return. The IRS knows they're receiving the other, but they know it's tax-free. We do this all the time, okay? The last example is a couple in California that came to us with $6 million in IRAs or 401ks. They wanted to convert to totally tax-free. They were fed up. They just wanted to bite the bullet and pay the taxes now. Now, the IRS was thrilled. We did a strategic rollout, and they paid $2 million out of that $6 million in tax in 5 years. They netted $4 million after tax. We doubled that $4 million in 7.5 years to $8 million. They now have $8 million generating between $600,000 to $800,000 a year of tax-free income. They don't even need that much. They don't even have to file a tax return. The IRS knows they're receiving that money, but they know it's tax-free. They are thrilled that they came to us to do a strategic rollout. Folks, check out to see if a strategic rollout is right for you. I would recommend that you read some stories in this book and see actual examples. This is my latest best-selling book that's flying off of our warehouse shelves. It's a 300-page book. This side is 200 pages that has all the charts and graphs. And we dedicate many of those pages to illustrating strategic rollouts. If you learn more by stories or examples, you flip it over to this side. This has 12 chapters. One of those chapters is dedicated to 5 stories of people we did strategic rollouts for. So if you like to learn by stories or by actual charts and graphs, right brain, left brain, this book is for you. Here's how you claim your free copy. Simply go to Laser Fund, laserfund.com. What is a laser fund? It's a properly structured indexed universal life insurance contract, structured the way to accomplish the goals that I've been talking about here for strategic rollouts. And so go to Laser Fund or click on the link below and you contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost and I'll pay for the book. You can go to Amazon and pay $20. And if you do, thank you. But I'll gift you a copy free. And while you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's audio and video options. There's even an 18-hour masterclass in there you can invest in. There's educational webinars that are free. We teach on a regular basis. But you can schedule an appointment with an IUL specialist that I mentor and I oversee. They can structure some illustrations for you at no cost, no obligation, to see how it's done correctly, to see if an IUL policy is right for you. because I don't want you to be left in the dust. I don't want you to go through the year 2023 and realize that you missed the boat. You could have begun to convert your money to tax-free strategies.